All right, good morning, guys. You guys should have finished up. You're due now. In your own words, explain how a mutual fund works and why people invest money into them. You guys remember from the previous lesson that a mutual fund is essentially when I have a lot of people who don't have a whole lot of money to invest themselves, so they get other people to come around and they all bring their money together and hand it to a money manager or some sort of financial type guy. So put the money in the middle, and then that guy sit there and invest a little bit of money here, a little money here, a little money here, a little money here. So he spreads out the investments or diversification, and so then when those investments make money, everybody makes money. When those investments lose money, everybody loses money. And also how if I say I put in $100 and Casey over here only puts in $50, I would obviously get more of the profits because I risked more money than he did. All right, so just a quick recap. The last lesson we covered the first two types of investing, money market accounts and mutual funds. We also covered some basic investment type vocabulary. So today we're going to start wrapping up that particular section. So first thing we're going to cover today, I'm guessing most of you guys have probably heard this term in the past, but maybe just not sure exactly what it means or what it is. We have bonds. Bonds are an IOU, like I owe you money, if you guys are unfamiliar with that, from a business or the government that is given to an investor in exchange for money that has been agreed to be paid back at a later date with interest. So kind of a lengthy definition, just kind of bear with me. So once again, bonds. They're an IOU from a business or the government that is given to an investor in exchange for money that has been agreed to be paid back at a later date with interest. You guys remember from previous lessons, interest is just the extra money that people receive in exchange for lending you money. So when banks charge you interest, you pay them back the money that you borrowed from them plus a little extra. It's how they pay their people. It's how they make money. It's how they make a profit. So IOU from a business or the government. So if you imagine a bond, just a slip of paper, it says bond at the top. And let's say it's for $1,000, $1,000 bond. You guys can see that easily. And so they'll say, okay, we'll have a bond. They'll have the interest rate, let's say 10%. And we'll say date, what's this year, 2019, we'll say 2023. So name of the bond, the amount the bond's worth, the interest rate, and the amount of, the date in which the bond needs to be paid back. So the way that this works, and the time and interest and all that varies from place to place. But essentially, I would go and give them $1,000, and they would hand me the slip of paper. And so, let's say every 6 months or so, they would pay me 10% of that bond. So, quick math, 10% of $1,000, okay, it'd be $100. Now, this is a very high rate. This is not realistic. I'm just using it because it's easy for math purposes. So the point is, so every 6 months or so, up until 2023, every 6 months, they would send me a check for 10%. So it's like they would send me a check for $100 every 6 months up until the year 2023. And then once that date comes, it's called the maturity date, they would pay me back that full $1,000. So I get back the money I gave them, but I also get all those interest payments up until the maturity date. And so that's how I make money off it. Once again, it does not happen overnight. It takes time, it takes patience, but over a long period of time, you can build more and more wealth. Oh, and actually got ahead of myself. So the second term we're going to cover is, in fact, maturity. And so when it comes to economics, this is talking about what we just discussed. Sorry, maturity date. It is simply the date a loan or bond will be paid back. So, bonds and then maturity date. One more term to cover real quick, and it's the one most people think of when they think about investing. We have shares/stocks. So even though this can be one of the more complicated ones to understand, in some aspects it's actually quite simple in others. So I'll write down the definition and we'll go over it. So shares and or stocks are partial ownership in a company, of a company or corporation that results in equal distribution of profits. So, once again, shares/stocks are partial ownership of a company or corporation that results in equal distribution of profits. So what this means, if I go off and I say I buy a share or a stock of Amazon, so what that means is when I go and buy that share, that stock, even just one, I essentially own a part of the company Amazon. I own part of the company. And it goes for any company that I buy shares or stocks in. And as long as it's what's called a publicly traded company, meaning the company has said, hey, we're dividing up our company and we're giving shares out there for people that they can buy in order to help us raise money. People can own pieces of the company. So everything from Amazon to Walmart to Target, Nike, GameStop, Netflix, all these are publicly traded companies. All these companies, you literally go online and buy a piece of these companies. And so when the company's doing well, you make money. When the company's not doing so well, you don't make money. So the next logical question is, how do you make money off these? Well, there's two ways. First off, people trade these shares and stocks. So what that means is, if I go and say I buy a share of Amazon, so let's say $50. It cost me $50 to buy the share. On the stock market, essentially just a market where people go and buy shares and stocks. And so from the hours, I believe, from 9 to 4, Monday through Friday, the price of these stocks are constantly going up and down. So when it starts, it'll say start at $50, and then it'll go up to 51, then drop to 47, and jump up to 57, and then go up and down all day. So the way I make money off it, I buy it at, say, $50, and then say by 2 o'clock, the prices jump up to $70. So then, at that point, I would go ahead and try and sell that stock. I would say, hey, I would like to sell my share or my stock at Amazon. So I buy it for $50, then I sell it at 2 o'clock for $70, and congratulations, I just made $20 profit. And so that's one way people will make money from this. And if you multiply that by, say, if I buy 100 shares, 1,000 shares, obviously you just multiply your profits by that much. And that's how people can make lots of money trading stocks. Now, another way, if you're a shareholder or if you have stocks, some companies will do profit sharing. So if a company has a very good year, some of their profits they will give out to their shareholders. Some companies do, some companies don't so much. So once again, bonds, an IOU from the business or government that's given to an investor in exchange for money that's been agreed to be paid back at a later date with interest. I buy the bond, they pay me interest every 6 months, and eventually at the end of the maturity date, they pay back the full amount. The maturity date is just the date the loan will be paid back. than shares and stocks, partial ownership in a company or corporation that results in equal distribution of profits. So, at the end of the day, hopefully I can maybe show you guys this more in depth when I get back. But like I said, there's, especially with online websites, apps, or whatnot, people buy, sell, and trade stocks all the time just simply from their phones. I even got one on my phone here. And so, any more questions about that? I know there are a few teachers around that kind of dabble in it, so maybe just ask around if you want some immediate feedback. Or, as always, shoot me an email if you have any specific questions. And I'll step aside here in just a second in case anybody can get all the notes down. And if you need to at any time, go ahead and hit pause. All right, so exit slip. Taking into consideration what we discussed here and the previous lesson, in your opinion, what do you think is the smartest type of investing as far as being safe but also making money at the same time? What do you think is the best out of the four that we've discussed? Money market account, mutual fund, bonds, and stock/shares. Which, in your opinion, do you think is the best? Write down your answer and explain. And then I'll see you guys for tomorrow's lesson.